FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 12/20/19. You know, the month is gone. The year is gone. What have you accomplished? What do you wish you had done that you didn't? And what did you do that you wish you hadn't? Let us know. A simple email to kl@kerrylutz.com will be more than sufficient. And on that note, we neglected to mention the passing of a legend last week. I'm talking about former Fed Chair Paul Volker. The guy was about 6 foot 8 inches tall, thick, and he always had on his person a Churchill cigar before they were universally reviled and repelled by the more civilized and refined elements of our society. He's largely credited with breaking the back of inflation and also credited with double-digit interest rates on treasuries, 20% interest rates on bonds, and cutting back credit card debt, a whole bunch of things that he did. Well, is he a legend or is he a myth? Well, Keith Weiner, who you will find on monetary-metals.com, a bit of a monetary gold authority, thinks more myth than legend, but we'll let Keith talk. So, Keith, welcome back. And we see that Volker passed, and he's being lauded as the man who broke the back of inflation. But you have another opinion, don't you?
Yes, I do. And at the risk of, and I never like to speak ill of somebody who's passed, especially recently. So as my usual habit is, I'd rather focus on what powers the Fed actually has rather than the particular man who happens to be in the seat of power. I always try to frame the debate. It's not who has control. It's whether anybody should be given that kind of control. Because, of course, what the Fed does is they set the single most important price in the economy, and that's the price of credit, specifically on the overnight rate or the Fed funds rate. And so Volcker got into office August, I believe, 1979, near the end of a very long trend that began at the end of World War II, which is rising interest rates and rising prices. And so the mainstream theory, people think that you increase the quantity of money, you get higher prices. But it's actually been observed by even monetarists such as Newt Wicksell in the 1890s that it's not the quantity of money that correlates with the price level, it's the interest rate. So if you think about it, what does interest rates do? Well, if you want to manufacture something, you've got to borrow money to buy equipment, manufacturing tools, building, real estate, all that stuff. The cost that you have to pay for that credit is a major factor in the price that you have to charge for your goods. So as that interest rate is rising, then manufacturers who've already borrowed at the lower rate have more slack to charge higher prices. They have pricing power, and new entrants find it harder and harder to borrow at these higher rates. So you get kind of a ratchet effect. Prices are going up, interest rates are going up. And all during that time, everybody's trying to hoard commodities. This is the destructive thing of that era. And I can distinctly recall my parents in the late 70s. Every week we'd go to the grocery store. Number one, every single price of every item was higher than it was the previous week. In fact, grocery stores used to, in those days, of course, there wasn't barcodes and scanners at the checkout counter. There was a little price tag on each can of tuna fish and each bottle of soda. And what the grocery stores used to do is if they had to do a price raise while they still had some inventory, they would actually send a stock boy out and re-sticker a new price. They would try to line it up to get it over the old price. And of course, people would try to peel off the new one, get the old one, because the cashier wouldn't know the difference. I remember in my town, New York, there were some idiots that were trying to lobby for a law to make it illegal for grocery stores to re-sticker a higher price once the item had been stickered. Mm-hmm. Not the era that we're in today, for sure.
Yeah.
So I can distinctly recall my parents, like if tuna fish was slightly on sale or there's a coupon or something like that, they would buy like 75, 100 cans of tuna fish. We would eat like one can a week for, Sunday brunch or something like that. But they would buy so much of it because it was preferable to have, food in the pantry bank than dollars in, the bank.
Mm-hmm.
And so that kind of hoarding is basically a race between people increasing the amount of consumer goods that they're storing versus, production. And that increase in hoarding, is winning. So prices are going up. Now, corporations get into the act because they realize the easiest way to make a profit to buy their raw materials and take as long as they possibly can to turn those raw materials into finished goods and sell the finished goods on the market. So they build in a buffer at each stage of both raw materials, and then at each stage of the manufacturing process, they would have a warehouse with sort of partially finished goods.
Right.
The difference is corporations.
Yeah. So another aspect is it turns everybody into a deadbeat, because when prices are rising and you've got high interest rates, the longer you can hold on to that money before you pay it out to your creditors, the higher a return that you make. So it has this like mushrooming, cascading effect throughout society where receivables go up and payables go up, which is not a good thing.
Right. Yeah. There's 100 ways that it's destructive. So the point is, corporations are borrowing to increase their hoards, but they're profiting because the price of the goods are going up. So that's why interest rates are rising, and of course, prices are rising. I like to compare and contrast, because a lot of people think we're in this age today of inflation. They say, well, the CPI numbers are a joke or they're a lie. And they say that, the Fed has printed so much money post 2008 that we're going to have one hell of a wave of inflation. And I like to point out the difference between the era we live in today and the era of the late 1970s. So that was a time of, every corporation hoarding as much intermediate goods and raw materials as it could. Imagine today going into the boardroom, pitching to the board, hey, I've got a great idea how we're going to make more money. They're going to be like, what's that? Let's build some warehouses, and then we're going to just stockpile goods at every, we have 20 stages in our production process. We're going to put in a buffer of goods at each of the 19 in-between points. And we're going to have a 6-month stockpile of our raw materials. You'd be lucky to walk out of that room with your head.
Mm.
That is not an idea that would work today, but that's how business ran in 1979, because that was the easiest way to make money. And even Keynes talks about that when you have rampant inflation, those bourgeoisie that are in a position to buy goods and then wait for the price to go up and then sell them are making money. Everyone is generally impoverished, but those few that are in that position are enriched. And even their fellow bourgeoisie can see that, it's unjust and, get angry. And that's how you foment, one of the ways you foment revolution. But that's, anyway, so Volker takes office in 1979 at basically just about the end of this incredible trend that had never before been seen in human history. Now, Volker actually has his little role that he plays in that particular trend, because 8 years earlier, he was one of the key advisors to President Tricky Dicky Nixon, who said we're going to temporarily suspend the convertibility of the dollar into gold and other reserve assets, in a speech that should go down in infamy August 15, 1971. And by the way, that's on YouTube, so anybody who hasn't seen it should go to YouTube and find that, watch that incredibly dishonest little speech by Nixon. Volker was one of the people who said suspend redeemability. And so, although he is hailed as the guy who broke the back of inflation, he was one of the contributors of arguably the biggest single event that precipitated it in 1971 by severing the last link between the dollar and gold.
Yeah, well, in the end, the Fed's going to do the president's biting, whether you like it or not. So now here we are. We know what happened then. So what exactly, in your opinion, is happening now, and why is that as bad or worse than what Volker did?
FSN Radio. It's all about what's next.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The Financial Survival Network. It's all about what's next.
So in a falling interest rate, you have various incentives to destroy and consume capital. And that's the destructive mechanism we have today. So I like to talk a lot about two of them. Let me see if I can summarize them briefly, verbally. One is every time an asset price is rising, then a speculator is selling an asset to the next speculator at a higher price, and his profit does not come in investing. Your profit comes from financing something productive. So you help, a factory buy some tools, they increase their production, there's more goods and services being produced, and your profit as the investor comes from part of that increase in production. But in speculation, your profit comes from the next investor's capital. Someone is forking over to you his life savings, and part of his life savings is your profit, your income, which you can spend. I call it the prodigal son effect. I wrote an article on townhall.com a couple of weeks ago about that. So every time the price is rising, somebody's cashing out someone else's savings to consume and spend. And if a society makes it profitable to consume savings and consume wealth, they're headed for deep trouble. The other is that every time the interest rate falls, it is a fresh new inducement to borrow. It's as if the market is coming to you and saying, hey, Mr. Lutz, would you like to borrow at 10%? You say, no, thanks. They come back next week, hey, what about 9%? What about 8%? What about 7%? What about 6%? And everybody has a line at which they say, I'm going to buy that 90-inch flat screen TV because they're offering 0%. And how can I go wrong? Well, the answer is you still have the debt of, $10,000 for the TV, regardless of the fact that, the interest rate is 0 on it. And so it lures consumers into debt, which is obviously one of the big problems we have. And perhaps even worse is it lures the next producer into each industry. So suppose you look at the hamburger business and you see that there's a 8% return on capital, and then they lower the interest rate to 5%. So you can borrow at 5 to make 8. Well, it's a no-brainer, right? And so then they drop the interest rate to 4%. The next competitor comes along and he puts the squeeze on you. You're paying 5. He's paying 4 for the same capital. He has a sustainable competitive advantage. And there's, no matter how smart you are, you can't really overcome that. So he's looking clever. You're looking kind of foolish. Then they lower the interest rate to 3%. And the next guy comes in. You're out of business. Your competitor isn't so happy anymore. And the new guy's looking smart until they lower the interest rate to 2%. And so this leads to soft consumer prices. No manufacturer, no retailer has pricing power anymore. If you go to any shopping mall, you see sort of permanent signs that say 50% off. Even right now before Christmas, there are huge sales everywhere that I've looked. And, consumers love it, but this is coming out of the backs ultimately of the investors of the companies that are selling at, razor thin margins that may cover their cost of goods sold, but not their capital, which they're consuming. And of course, in the rest of the world, interest rates have gone negative. Mm-hmm. Right? In the United States, as bad as it is, we still have a positive interest rate. You go to Switzerland, you go to Germany, you go to Scandinavia, you go to Japan, it's negative. And so think about the perversity of a negative interest rate. Imagine you're running a wealth-destroying enterprise that destroys your capital at a rate of 1% per year. Right? In any normal universe, you should be out of business. The sooner the better. But imagine you could borrow at minus 2%. You would actually book a profit of plus 1% and pay bonuses to the executive management team. And that's the environment that, not Volker the man per se. I don't think he understood this dynamic, and I don't think he had nearly so much control over it anyways. But that's the era that was hailed widely that followed 1981 when the rate finally spiked. The era that we were plunged into post-1981 is this era of falling interest rates, soft consumer prices, and endless bull markets, which is the euthanasia of the rentier. That's where we are today.
All right. Not a pretty picture at all. And so what is the solution here for Joe Sixpack so that he doesn't get swept up in this eventual or inevitable disaster?
Well, one piece of advice I think is always good advice in good times and bad, which is avoid getting into debt, especially consumer debt, and, pay off your debt if you're in any kind of position to do so. Also, be careful about debt for, business purposes or for purchasing assets, because we're in this environment where, asset prices can run up massively, but then the higher they run, the greater the risk that there's a correction, and the corrections get bigger. So the correction of 2008 was pretty big. Anybody that was buying assets on leverage was obviously wiped out. And then be mindful that nobody can predict the timing. Anybody who says it's going to happen on December 31, my peeps tell me, that's rubbish. But some sort of calamitous event like that is certainly baked in the cake. Beyond that, I think the best thing people could do is study up about this stuff, keep their eyes open, understand what's going on, and then, position yourself conservatively and position yourself appropriately.
I got your point there. And so how do you position yourself appropriately? What do you do?
I think, right, so everybody looks at equities, for example. I would be very careful with equities because there are synergistic effects where all this borrowing, of course, fuels spending, and that fuels earnings. The earnings go up, and then the multiple, the P/E ratio goes up as well. So the stock price is a higher multiple of higher earnings, both of which are fueled by incredible, credit spigots that are being turned on. But when things seize up, when suddenly, so there's an old expression I remember when I was a kid, the mothers used to say when we go out in the woods and play, which is, boys, it's all fun and games until somebody puts out an eye. Well, the credit world is all fun and games until somebody defaults on a payment. So when that happens, then credit markets seize up, and so many banks and so many corporations are borrowing short to finance long assets. So they borrow, let's say they sell a 2-year bond, but it's a 20-year asset, or they borrow in the overnight market for, longer term stuff. Well, when the market seizes up, that means they can't roll the liability. They have a loan that's due, and they can't take another loan to replace the first one. And so then they're in default, and of course the creditors want to get paid. So then they want to seize everything and liquidate. And so all of a sudden, this, supposedly benign credit process slams into reverse. And as you look at 2008, you can see the incredible drop in revenues, let alone the incredible drop in profits. And so, my pitch for gold is a bit different, I think, than most people's pitch. I'm not going to sit here and say the price of gold is going to go to 20,000. I think at the end of the day it will, but that's when the dollar is collapsing. But at the moment, the case for gold is, by owning gold, you own the one financial asset that is not someone else's liability. If you own a piece of paper, whether it's a dollar bill or obviously a share, you own something that somebody else owes. And if that other party gets into trouble and then defaults, then the thing you own suddenly becomes worthless or pennies on the dollar. If you own a piece of gold, you don't have that problem. And so I think the best modern day example for that is Cyprus. Some years ago, the Cyprus banking system collapsed. And so they declared a bank holiday, did a whole bunch of things. They cheat, they change the rules, they suspend the rule of law. The bank can do whatever, you can't withdraw your money, all that good stuff. Bail-ins. Anybody who had their money tied up in a Cyprus bank was screwed. You potentially wouldn't have even be able to get off the island unless you had some cash in your pocket. Because I'm sure at that point, people that ran the boats wouldn't take a check drawn on a Cyprus bank. But if you had bought gold, you had something that was recognizable and valuable anywhere in the world. If you had gold, you would have had no problem getting a boat to mainland Europe, where there were jobs and things were relatively good. And so the point being that it's not that the price of gold went up through that incident, as I recall, it didn't. I think that was 2013. If anything, the price of gold was in a downtrend, but gold didn't suddenly seize up. Gold didn't suddenly lose its value, which is what happens to paper assets in an environment like this at the appropriate time.
All right. So interesting. So precious metals, assets with no counterparty risk, real estate can be dangerous. Well, anyway, we have to wrap up right now. So just to let us know here, where is the best place to find you these days?
So my company, we pay interest on gold. That's our unique, little thing. So if people want to own gold, it's better to get paid interest on it than pay for storage. Our website is monetary-metals. That's the plural, monetary-metals.com. And on Twitter, I'm KWeiner01.
All right. Excellent. And we'll have a link to your site in the show notes to this interview on Financial Survival Network. Appreciate your coming on and sharing your wisdom, Keith, and your view of history. The email address. Any questions or comments? KL@KerryLutz.com. Twitter feed @KerryLutz. Facebook page is Financial Survival Network. And of course, our site is financialsurvivalnetwork.com. Make sure you subscribe to our newsletter. Just sent one out today. Keith, been a pleasure. Thanks so much for stopping by.
Thanks for having me.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.